Buying a stock is easy, but selling is very, very hard. It's not easy to sell. Most people don't really know when to sell a stock. It's a very hard decision to make. In this video, I'm gonna do my best to explain to you when and how do I personally decide of when to sell a stock or how do I go about doing it. It's gonna be an amazing video. I'm confident you're gonna love it. All I'm asking from you, if you could please press the like button, and if you do enjoy it, let me know what you think in the comments. If you like it, you don't like it, just let me know your opinion. Okay. Now, before I get into the three reasons of when you should be selling the stock, I'm going to go into the three reasons of when you shouldn't be selling the stock, because this is stuff I see very often. I'm going to go into it first, then I'm going to tell you when I believe people should be selling stock. The first one is selling a stock because the stock went up. This is a very bad idea, or I should say, taking profits. People always say, yeah, it never hurts to take profit. No one went broke taking profits. This is true. But taking profits just because the stock went up is normally a very bad idea. And I know all that stuff from experience. One of them was Apple. I talked about buying it at 16 times earnings in 2018. I sold it in 2019. I made like, I don't know, 35 or 40% because the stock went up too quickly. It got a little bit overvalued. So I'm going to take profits and move on. So I took profits, and it's one of the worst decisions I've ever made. And the truth is, you shouldn't really sell a stock just to take profits. You should sell a stock if it gets too overvalued. So maybe the stock goes up, let's say 50%. But if earnings went up 100%, the stock is actually cheaper after it went up. This is what a lot of people don't understand. So if you buy a stock at $10, it goes to 15. But let's say earnings doubled. At $15, the stock could be cheaper than it was at $10. And sometimes in this case, I personally would dollar cost average up instead of trying to sell the stock because it went up. But a lot of people, they don't really focus on the fundamentals. They focus on the price. If the price goes up, they automatically believe that the stock is overvalued and they should take profits and move on. But maybe the value went up more than the price. And in this case, the stock could be cheaper even after it went up. This is a very important concept that you have to understand. It's not much about the price. It's more about the value. And if the value goes up more than the price, then the stock could be cheaper. And maybe it makes sense to dollar cost average up instead of trying to take profits. Okay. The second one, which is a very popular one, and this is selling the stock because the insider sold. So a lot of people have this notion, and it sounds very smart, that you look at the insiders, the CEO is selling, Jeff Bezos is selling, the insiders are selling. So maybe they know something I don't know. So I'm going to go with them because they know all that stuff, and I'm going to sell also my stock. This is a very, very bad idea because you have a lot of companies like Walmart. Walmart, the manager, the CEO, and the directors, they've been selling for years. And Walmart stock, you look at the chart, it's way up. And the insiders, they keep selling stock, they keep selling stock, they keep selling stock. They never stop selling. They never bought the stock before. So all they do is sell. So if you sold Walmart like in 5 or 6 years ago, just because the insider was selling, you made a very big mistake. There's all kind of reasons for why insiders are selling. And if the insider doesn't have a track record of buying at a specific price, and all he did was sell, and all the insiders are selling because the company has high stock-based compensation, for example, like Amazon or other companies, then it's not as useful of a metric. So selling the stock, even if you love it for the long term, even if it's fairly valued, just because the insider sold, is a very bad idea. You could take it into consideration, of course, but I would never personally sold a stock just because the insider sold. But a lot of people go by that stuff, and I think it's a very big mistake. Okay. The third one, which is a very important one, selling because the stock became a large percentage of the portfolio. This is a personal preference, so maybe it's up to your risk tolerance. But for me personally, I have stock in my portfolio right now that's 13% of my portfolio. And I'm not selling a single share. And if it goes to 25% of the portfolio, I'm also not selling a single share, because this is not how I think about that stuff. I don't think of how big of a percentage the stock is. I think more about how much am I risking from my own capital. So if I put, let's say, 5% of my portfolio in the stock and it doubles and all the other stocks stayed flat, and it goes up 100%, and it goes to 10% of the portfolio, I'm not going to sell it just because it became a large percentage. This is a very bad idea. It's a good idea to let your winners run and just let them run, even if they become a large position. That doesn't mean anything. Diversification, I don't believe in it. I just let it run. I don't touch it. and it just keeps on going. And this is the advantage that we have as retail investors over hedge fund managers. There's this story about some kind of hedge fund manager that owned Walmart back like in 1980s or 1970s, and he had a rule in his portfolio or a regulation where he couldn't own more than 5% of his specific stock in the fund. So he had to keep trimming Walmart. Walmart kept going up. He had to keep trimming it, keep trimming it. He got nowhere close to the amazing returns that Walmart delivered just because he had to trim it for certain reasons. But us as retail investors, we don't have that stuff. Why should we abide by such rules if we have the freedom to do anything we want, hold as long as we want, and as much as we want? So for me personally, I don't care if it becomes 50% of my portfolio. I'm not de-risking if I'm selling a stock. That doesn't make sense. I don't take profits because the stock went up. I don't sell if the insider sold, and I don't sell just because the stock became a large percentage. Very big mistakes. Okay, now this is 3 reasons of when you should actually be selling a stock, or this is when I personally sell a stock. The first one, when the stock gets extremely overvalued. Not just a little bit overvalued. Sometimes they can grow into the overvaluation, but sometimes extremely overvalued. One example is a stock I bought, which was LVMH. I bought it as exactly $145 in January of 2024. The stock goes up as high as something like 190 or 188. I sold it at 183, but ended up going to like 185 or 188. I made like, I think 27% on it in 2 months. And the stock was just extremely overvalued. It was trading at 26 or 27 times earnings, growing earnings per share maximum 7-8%. To me, it was just extremely overvalued relative to other opportunities, and I sold the stock. Now, maybe the stock would have kept going up and it would never have came back down. I wasn't trying to predict where the stock would go. But in this case, for me, LVMH became extremely overvalued. So if you have a company, let's say something happened, like GME or whatever, it gets extremely overvalued, it's growing EPS 5%, and it's trading at 100 times earnings, then I would sell it. But if it just goes up a little bit in terms of a multiple expansion, I don't sell the stock if it's just overvalued, but I only sell it if it's extremely overvalued. I sell it and I move on. The second one is, this is the most important one that I talked about in my video, which is called Don't DCA. This is what the title says, or the thumbnail. And a lot of people misunderstood that I wasn't saying you should never dollar cost average. I only said you shouldn't dollar cost average based on the price, but only if the fundamentals make sense. So if you have a company with deteriorating fundamentals and you're down 20%, maybe it makes sense to sell the dip instead of just keep putting money into a dying company that's just going out of business. It doesn't make sense at all. So if you buy a stock because of a reason, you buy it for some kind of thesis, and if this thesis changes, you have to be able to change your mind and move on immediately. No matter what other people say, no matter what your friend call you a trader or investor or whatever that stuff is, no matter what happens, you have to instantly be able to change your mind and move on. Not marry the stock, not miss the stock, not look at the chart to see if it went up or if it went down to see if you made the right decision or the wrong decision. You have to sell and immediately move on. And I've done it so many times and I saved so much money. I also lost some money, some gains, but that's what I do. If I bought the stock for a reason and this reason changed, I exit immediately and I move on, no matter how much I'm down on the stock. I don't wait to get back to break even. I sell it and I make my money back with something else. That's how I do that stuff. And one of them is Lumen Technology. I talked about it. I bought it at 515 or 522 or something, and I sold it around $5 per share. Why? Because I bought Lumen because I saw Lumen had a lot of tangible assets, valuable assets. It had a lot of that, and it cuts the dividend to zero. I'm like, okay, now they have some free cash flow. They can sell some assets and use the proceeds to pay off the debt, reduce interest expense, increase net income, increase free cash flow, and things are back. You know, Lumen doesn't need to grow. All they need to do is pay down the debt. This was my thesis. Then I had a new CEO come in. Her name is Kate Johnson. She used to work at Microsoft. She came in. She wants nothing to do about paying down the debt. All she wants to do is invest for growth. And this is when I realized that my thesis changed and I immediately exited the stock. I lost around 8% total and I moved on. And if I held Lumen from my price, I would have been down 73%. Now, maybe Lumen would have been up, and this is not another case, but I have stocks, for example, like CVS. CVS, I sold it pre-market on earnings, pre-market. People in my own investment groups, they went crazy because it was 8% of my portfolio. But when I saw the earnings and I saw what the managers were saying, I sold it even before the market opened. I don't want nothing to do with it. I don't want to hold it to hold and hope I come back to break even so I can, make my money back and feel better. I cut it off and move on. And most people can't do it because they put up so much research, they get excited, they marry the stock. But Warren Buffett doesn't marry stock. He doesn't care about them. He cares about what can make him money, and he cares about reducing his losses as much as possible. That's why he ended up exiting, Paramount at a loss instead of buying more. That's why he exited airlines at a loss instead of buying more. And this is what these investors do. And you can't just marry a stock and fall in love with it and all kind of feelings. You have to be able to exit at any time and move on no matter where the stock is. The last one is when you find a better investment. So if I hold a stock, let's say LVMH, and let's say I'm flat on it or down a little bit or up a little bit, doesn't matter. And I look at my entire portfolio, I love all my stocks, but LVMH doesn't have much upside from here. It doesn't have that much growth potential. But I find an amazing, let's say, small or micro cap stocks, which what I invest into, I share my stuff and my investments in my group if you're interested. But let's say I found a shiny small cap stock, growing earnings 20%, trading at 15 times earnings. And to me, it makes much more sense. And I would sell LVMH because I found something better. And that's the only 3 times I would sell. If the stock gets extremely overvalued, when my thesis changes, I immediately move on. When you find a better investment, or sometimes I do and I sell them. And that's what I have for this video. I hope you learned something. I hope you enjoyed it. I have many more of that stuff in my group again, so maybe you can give it a try. But thank you again. Thank you for supporting me. If you enjoyed it, press the like button. No financial advice, of course. And I'll talk to you in another video.